So today we had a health insurer purposefully abandoning over 1 million customers just to protect its margins, while an airline literally ran out of physical runway space.
Right. It was a fascinating batch of reports. Between UnitedHealth, United Airlines, Taiwan Semiconductor, and Netflix, the earnings quality looked really strong underneath. Even the Wall Street decided to fade almost all of those stocks by the close.
Well, the main theme that jumped out was companies completely throwing away empty volume. UnitedHealth basically said they're willingly dumping 1.1 million Medicare Advantage lives next year just so they can escape unprofitable contracts and lock in a strict 3% margin floor.
United Airlines is running that exact same playbook. They essentially warned that the standard high-volume airline model is broken right now. They only thrived this quarter because they captured a 27% surge in premium business class revenues. Management teams are shrinking their mass footprints to hoard premium value.
It's not just shrinking the customer base either. They are aggressively using AI to erase mass volume internally. I mean, UnitedHealth rolled out a system that automatically processed 69,000 hospital authorizations. That instantly wiped out 69,000 human administrative hours in a single quarter.
Which is exactly the dynamic Netflix highlighted. They used generative AI to halve the post-production time and cost on over 300 documentaries. It proves that downstream companies are finally generating real tangible labor savings from all this tech spending.
Except all this digital optimization is violently crashing into the real physical world. Taiwan Semiconductor has basically limitless demand for AI chips, but they physically cannot service all their clients because they lack the factory floor space for advanced packaging.
Yes, you cannot scale infrastructure at the speed of software. TSMC's constraints are no different than United Airlines being legally barred from adding new flight routes in Chicago and Newark. They hit the absolute FAA ceiling on physical runway slots. The growth is bottlenecked by cement and regulations.
Speaking of optical limits, I think we should quickly mention Netflix's free cash flow. It looked like it plunged 70% from last quarter, but that was really just a massive illusion.
Totally. That drop was mostly a giant tax payment they had to make. They had a huge cash windfall last quarter from a canceled Warner Brothers deal, so the tax bill just hit today. The underlying cash engine there is totally fine.
Okay, fair. For the watch next, I think we have to keep an eye on TSMC's profit margins. They are deliberately expecting a drop next quarter purely because they have to absorb heavy upfront costs for their new 2-nanometer fabrication lines.
Building the absolute best next-generation product usually hurts near-term optical profits. We saw the exact same margin drag on GE Aerospace today as they ramp up their new engine cycles.
Which means the real story is always in the trade-offs. The individual company episodes dig into exactly how these operators are managing these physical constraints and shedding that bad volume. Have a good one, Midrow.